Welcome to the fourth and final part of our HT wheel video series. We've walked through a real trade with the ticker SPCE as we've discussed the basic wheel strategy and gone into detail about all the modifications that our HT wheel strategy adds. We've set the play up by selling cash secured puts and utilized our early assignment method to take early ownership of the shares. Now that we've established principles regarding position sizing and discussed the advantages a coverage strangle provides, let's jump back into the SPCE example we've been using as we put it all together and find a way to make a big profit on a bullish play despite a huge drop in the stock. This is the Hourglass trader, where as time passes, we make money. Alright, so let's get back into it. If you've been following along with our video series, this is probably something you're very familiar with at this point. This is the spreadsheet that we've been using to track our trade and run through the example of showcasing how we run the HT wheel strategy. So picking up where we left off, the price of space started at 1840, dropped all the way down to 1692. Really just a bad break, but I think it's important for our example to highlight a situation where things go pretty poorly rather than a situation where things go really well, just to show you how easy it is to play defense when a stock moves against us. So we sold these 18 strike puts. We reflected a $510 loss in those because we used the manual assignment to close these early and get the shares at market price. Why did we do that? Because the extrinsic value on these 18 strike puts was gone, and we took advantage of that to use our manual assignment option and get these shares early. So one more time, why do we want these shares early? Well, let's have another discussion about theta decay. We know from our previous lessons that as time passes, the value of an option decreases due to theta decay. So when we're using that manual assignment option, we do it to get the shares early. If we had let that put expire and took assignment via broker, the automatic traditional route of assignment, we'd get the shares in our account on Monday, which as far as the timeline is concerned on the x-axis, we'll call it right about here. And for the purposes of the calls that we're going to sell the following week, let's say that this curve represents the value of those calls. So if we wait until Monday, we're probably right about on this red dot as far as how much value is left in this option, since there's about a week left to expiration. And we'll say this represents about $6 of premium. So by using the manual assignment option, we're able to get these shares a little bit earlier. Let's say maybe 3, 4, 5 days early, but somewhere represented by right here with this red dot. And what this allows us to do is sell calls that are worth more premium. So this call that we sell maybe 3, 4, 5 days early could have $10 of premium, and that $4 difference that we get from assigning our shares to ourselves manually is a pretty big difference, and over time you'll see that add up pretty quickly. So that's just a quick aside as to why we use that manual assignment option to get the shares early, to sell calls a little bit earlier and collect more premium cumulatively throughout the trade. So let's go back to the spreadsheet. And we're picking up right where we left off. We've got the shares. So what do we do from here? Like we mentioned in part 3, we jump right into the coverage strangle because our basis at this point is 1746. Not too bad since it started at 1840, but we know from the previous lessons that we've had as part of this HT wheel video series, we can do better than that. So what do? We sell calls as the first part of the coverage strangle. We sell 17.5 strike calls because that's above our current basis of 1746. We get 50 cents of premium from those, which decreases our basis by 50 cents. And the 16.5 puts are the other half of that coverage strangle. We get a 34-cent premium from those, which takes our basis from 1696 down to 1662, which for being in a trade for 2 weeks when it started at 1840, having a 1662 basis is pretty dang impressive. So we might have a little bit of a spoiler here in column K, but the price of space at the end of the week went up for us, which is always what we're looking for since the wheel is a long position. But going up to 1746, we're now in a gain position from these shares that we purchased. And if we sum up the profit and loss that we have here in column G, we're actually making money on the trade now. So despite the fact that the stock that we went long on has decreased 5.11%, we're sitting on a 4.83% return. So we know from this position, what are we going to do? 16.62 basis. We've got 1,000 shares. We've only used 50% of the collateral we're comfortable with using. We're going to sell another coverage strangle. And that's exactly what we did. So we sold a 16 strike put for 16 cents in premium, and then sold a 17.5 strike call for about 68 cents of premium. And since our basis was 1662 going into that week, 17.5 strike would get us assigned above our basis, resulting in an automatic gain if those shares were called away. So that's a perfect strike to sell those at. On the flip side of the coverage strangle, we have this put right here that we sold a little bit on the more conservative side. We sold it a little bit lower than that 16.5 that we sold the previous week, but we always like collecting premium, so we did it to get that 16 cents. But here's where things kind of went a little further south. As you can see over here in column K, the price of space at the end of the week dropped to 1605. And if that didn't seem bad enough for us, as an added bonus, it dropped actually to 1520 during the week. So we did get to a point where these 16 strike puts were completely out of extrinsic value. So we picked up shares using the manual assignment option off the market for 1520. So that's what we did right here with this 1520. We closed these out for 80 cents and we bought what would have been assigned to us with the 16 minus 0.8 at 15.2. We took advantage of that lack of extrinsic value and we purchased the shares for 1520 off the market. But let's take a look back at the most important part of this. What's our basis after all that? So headed into the week, it was 1662. Now normally the 16 strike put that we sold would decrease it by 16 cents, but that's only if we hit max profit. Since we took a loss on this actually increases our basis by the difference between 0.8 and 0.16, bringing us to 17.26 as the basis. Now the 17.5 strike call, since the stock went down, we know that we're going to hit max profit on that. So that decreases our basis by 68 cents down to 16.58 right here. And then as far as what our basis is on these shares that we bought, we know that we own 1,000 shares with a 16.58 basis and then 1,000 shares with a 15.20 basis. So our basis going forward with our 2,000 shares is going to be the average of that at 15.89. Now, looking objectively at this, it sucks that we took a long position on a stock that dropped 12.77% on us. And the fact that when it was down at 15.2, it dropped 17.3% on us. Now, the beauty of this is that even though the stock has dropped 13%, our basis is 15.89. We do need to update our collateral since we bought shares at 15.2. But if we go to column G here and sum up the profit and loss from all of these plays that we've laid out along the way, we're actually sitting on a $350 profit throughout the life of the trade, despite the fact that a stock we were bullish on and made a bullish play on dropped almost 13% on us. We have a 1.05% return on capital. And that is the beauty of this HT wheel strategy. So let's talk a little bit more about position sizing as we touched on previously in this video series. Since this is probably about the top end of the collateral that we were comfortable with allocating to this trade, we've got it marked here as 100% for simplicity's sake. We're not going to sell any more covered strangles. We're just going to keep playing out the traditional wheel strategy where you would just sell covered calls endlessly until your shares are called away. But our advantage here is that now our basis is 15.89. Where with the typical wheel, we'd probably still be stuck at maybe high 16, low 17s. We almost have a $1.50 advantage over a basis on a traditional wheel play. And that's the advantage of the modifications that we add to the HT wheel. So to kind of finish this out and see where it went for us, let's see what we did from here. So we have a 15.89 basis. What are we going to do for the share price of the call that we sell for the next week? What we did was we went a little more conservative than the previous 17.5 strike calls that we did and went with 16.5. Since our basis is 15.89, anything above that getting those called away would be profit for us. And if we're in a situation where a stock has moved 13% against us, objectively, if we could set up a play where we get out for profit, that's phenomenal, and I'll take that 10 times out of 10. You don't want to get greedy and try to chase an 18, 19, 20 strike call to try to hit a huge return. At some point, it's important to recognize that the play just didn't work out the way you thought it would, and if you can get out for a profit, that should be your main goal. So that's what we did with the 16.5 strike call. And a little bit of a spoiler alert if you were looking over in column K, the price of space went back up to 16.72 that week, which was great for us. And typically these shares would get called away. But here's the deal. We had these shares with a sub $16 basis, and we really did like this stock for the long run, so we didn't want to get rid of these shares. But since it was above 16.5 but not too far away from 16.5, we were able to close these out for a debit of 25 cents, giving us a net profit of 18 cents of premium, which decreases our basis even further to 15.71, and we could sell another set of calls for the following week, and that's exactly what we did. So since this time the price of the stock was a little bit higher, we did get a little bit more aggressive, but not too aggressive. We went just under $1 outside of the money here, selling 17.5 strike calls for 35 cents a premium. At the end of the week, it went up to 17.2, which was great for us because we are now in a gain position on both of the sets of stock that we purchased. And if we sum up here, we kind of haven't been keeping track up to this point, but if we sum up the profit and loss in column G again, we've made $3,600, which is a almost 11% return on capital despite a 6.52 decrease in the stock. And 17.2, just to keep going through the process of how we finish this play out. Obviously, finished out of the money, so we're selling another set of calls for the following week for week 6. But as you can see over in column K, space took a pretty big dive that week down to 16.4. And at this point, our basis has been getting chipped away at the entire time. So despite the fact that we started at 18.4, it's down to 16.4, which is a super big percentage decrease Our basis is still 15.16, which is an incredible percentage below what space was trading at when we started this. So we're selling these conservative strikes, trying to get them called away. It dropped to 16.4. Obviously, we don't like it when the stock drops, but it's something we can manage as we continue. The following week, we sold 16.5 strike calls, and space went above 16.5 that week, which means we finally got our shares called away. And we know that when we sell a 16.5 strike call, it gives someone the right to purchase the shares at 16.5. So we had to sell our shares for 16.5. But at the end of the trade, if we sum it all up in column G, the profit and loss here, in just 7 short weeks, we made a $3,300 profit, which represents a 9.97% return on capital, despite the fact that we made a bullish play on a stock that decreased 10.33%. And if that isn't good enough, if we put it in perspective in the amount of time that we were holding this investment, a 9.97% return over this short of a period annualizes to over 100%. It's easy to make money when stocks go up forever. You've seen it. We've just exited one of the largest bull markets of all time. People are blindly throwing money at stocks and making money. But the question that always should linger in the back of your head is what happens when things go wrong? And this is example A of how we manage a position that goes poorly. Just to kind of hammer it home again, it dropped 10.33% against us, yet we were still able to make, through the power of option selling, a 102.58% annualized return. And that kind of ties together all of the things we've been talking about through this whole video series. We've used manual assignment, we've used position sizing, and we've used covered strangles to our advantage to kind of divert a little bit away from the traditional wheel strategy into what we think is a more profitable, more consistent, and more successful strategy with the HT wheel. So congratulations. If you're still with us, you've made it through our HT wheel video series, and at this point, you should be ready to put into practice what we feel is one of the single best value investing strategies in the market today. To recap quickly, we started out with selling cash secured puts, used manual assignment to collect shares ahead of time, sold a covered strangle, were assigned on the covered strangle, and then sold covered calls until our shares were called away for a 7-week profit that annualized to over 100% despite the stock moving severely against us. Now, what we didn't really touch on is the fact that we could have hit a max profit number during each of these steps, but we felt it'd be better to walk through an example where everything went poorly, since that highlights the value of the strategy. Majority of the time, we'd hit max profit on step 1, but that wouldn't make for too exciting of a video. So once again, we want to thank you guys for watching. It'd help us out a lot if you could hit that subscribe button to stay up to date with our content as it's released. We also have a free Discord server that we'd love for you guys to join, and the link to do that is in the bio. So until next time, this has been the Hourglass Trader, where as time passes, we make money.